In a surprising move, the Indian central bank has cut interest rates to 6.75%. So what does this indicate for the Indian economy going forward? I'm speaking now with Shilan Shah, Indian economist with Capital Economics. Shilan, India's central bank has cut its key interest rate by 50 basis points, a bigger move than the expected 25. So what's behind the bigger move?
Well, we think it's probably a case of the RBI front-loading policy easing. It was quite interesting, really. You know, you're right in saying that the decision to cut by 50 was unexpected, but this was actually accompanied by a not particularly dovish statement. You know, the RBI appears to have turned its attention to meeting its medium-term inflation targets, which might prove quite difficult. It also has left some of the onus to drive sustained economic recovery on the government and on the banking sector as well. And so, you know, in this regard, you know, while the size of today's cut was unexpected, we don't actually think that there's much more scope for further loosening further down the line.
This is the fourth interest rate cut this year, and according to the RBI governor, in India, a tentative economic recovery is underway, but is still far from robust. Looking ahead, what's likely to be their next move?
Well, we think the next move will probably be for rates to be kept on hold now, actually. You know, there are signs of a tentative economic recovery taking place. Industrial production growth has picked up over the past few months, although admittedly it still remains quite weak by its past standards. You know, there are signs in the soft surveys as well that capacity utilization is picking up as well. You know, all of which suggests that after years of kind of very weak growth, things are beginning to look slightly better. And, you know, as I mentioned earlier as well, there is the RBI has now put the onus on pushing or sustaining this economic recovery on the government and also on the banking sector. You know, there were some very specific references to banks having not passed on the policy rate cuts into the lending rate in today's statement. Now that suggests really to me that the RBI is going to sit on the sidelines for a little while now and wait to see if banks are actually able to pass on these rate cuts, all of which suggests really that we won't see any further cuts to the policy rate, at least for a little while.
Compared with other emerging markets, India is faring rather well, especially compared with China, as their slowdown threatens global growth. Will this slowdown have any knock-on effects to China, and what is their biggest risk at this time?
Well, we think the knock-on effects are relatively limited, to be honest. India's economy is very much domestically driven. The main drivers of growth in India are private consumption and also investment as well. And, you know, in that regard, it doesn't rely a huge amount on exports to actually drive growth, you know, which is part of the reason that there has been this onus on commercial banks actually lowering their lending rates, which should help to spur domestic activity. And so, you know, in that regard, the kind of concerns, I suppose you could say, over growth in China and its knock-on effects to the rest of the emerging world especially, don't really appear to be a significant threat to India at this time. You know, in addition to this, India's current account deficit itself has narrowed quite sharply over the past couple of years. So even the kind of indirect effects through potential capital outflows, India doesn't really seem to be among the more vulnerable emerging economies in this regard either. Really, what India needs is a kind of domestically driven policy and recovery, and that is the reason essentially for these, you know, for the 125 basis points worth of rate cuts that we've seen so far this year.
That was Shilan Shah with me there. Now, for more insight and analysis like this, make sure you're tuning in to Dukascopy TV. For now, though, it's goodbye.